So guys, in this video, I'm going to be answering some of the really great questions that I've been getting from all of you lately, starting with this one here from my friend Gabe, who wants to know what would be your strategy if you were just starting out at age 45? Now, this is a fantastic question, and it's one that I get pretty often from people who are a bit closer to retirement than I am. I'm only 31 years old, so naturally a lot of the content that I put out comes from the perspective of someone who still has a lot of time on his side before he plans to retire and start using his investments to pay his bills. But you know, this question does get brought up enough that I have spent a lot of time thinking about it. And you might assume that someone in their 40s or 50s would need to approach investing completely differently than someone in their 20s and 30s. And sure, there may be some slight differences, but I think in a lot of ways, the core strategy really doesn't change all that much. Whether you're just getting started at 25 years old or at 45 years old, I think the main goal here is still the same with all of this investing stuff. It's to build a portfolio of growing companies or ETFs comprised of growing companies that will continue to pay and grow their dividends over time. In other words, the whole point is to build a stable and growing stream of passive income that can support you down the road. And the way to do that, which is by investing in growing cash flowing businesses, doesn't change based on your age. And with that said, time is still one of the most important variables in the investing equation. And that's where we start to see a key difference. You know, someone who starts investing in their 20s has a couple extra decades of compounding working in their favor. It might only need to invest, like $250 a month to end up with $1 million by age 65. But if you're starting at 45, you'd need to invest closer to $1,700 a month to reach that same number by the same age. To me, this just speaks to how powerful time really is in the compounding and wealth building equation. And I think this is a great reminder of the fact that unfortunately there are no shortcuts to reaching financial freedom. You can't make up for lost time by chasing risky, speculative, high yield stocks or ETFs. And I know that doing so might feel like a way to get ahead, but more often than not, it ends up just setting you back. And I understand how all of this might sound a bit overwhelming, maybe a bit deflating. And honestly, it can be. But it's important to remember that starting later doesn't mean that you've missed your chance to build something meaningful. You still have so much time on your side, even if you don't start investing until you're in your 40s or 50s, because investing is an infinite game that you can play for the rest of your life. Even if you start at 45 and plan to retire at 65, your portfolio doesn't just stop growing the day you stop working. If you're healthy, you could have another 25 or 30 years of compounding ahead of you after that point, if not more, and that's a lot of time to see your investments continue compounding. Overall, the earlier you start, obviously the better off you're going to be. And even if you are getting started later in life, the fundamentals of investing really don't change. The game is still the same. The only difference is that you're just working with a slightly different clock. But anyway, guys, now moving on to our second question of the day. This one comes from my friend Robert, who says, "This market drop has been an adrenaline rush for me. I'm conflicted between continuing to dollar cost average into all my positions versus not funding some and redeploying the extra cash to positions with current drops in share price, or some combination of the two. I'm wondering what your thoughts are on this situation." Now, truth be told, I don't think you can really go wrong with any of these approaches. But personally speaking, I only dollar cost average into ETFs. I feel like with those, you can get away with buying them no matter what the share price is doing. And timing matters a lot less, I think, when you're dealing with something that tracks the overall market or a certain index. Plus, the whole point of investing in ETFs, at least for me, is to make the process as hands-off and automated as possible. So not worrying about timing fits right in with that approach. When it comes to investing in individual companies, though, I do treat that a little bit differently than ETFs. I mean, you can certainly dollar cost average into them, especially if it's a dividend stock, because you're buying that for the cash flow. But still, I personally prefer to focus on the companies where I feel like I'm getting the most bang for my buck. For example, it would make more sense for me to be putting more money into a position like Starbucks right now, since the current share price is below my average cost per share. As we can see here, I'm down a few percentage points. Buying it now while I'm down would give me the opportunity to lower my cost basis and bring my average cost per share down, which is a good thing. It would also allow me to increase my margin of safety with that position, which is also fantastic, while at the same time establishing a higher yield on cost. Now, on the other hand, that's exactly why I'm not adding to my Williams-Sonoma position right now. I'm still up over 100% on that one, so the current share price is still way above my cost basis. And to me, it just doesn't feel like as good of a deal right now, so I'm totally fine just letting that one sit and putting more money into something else where I feel feel like there's a better value there. And that's what it really comes down to for me. I want to look for those opportunities where I feel like I'm getting the most value for the money I'm investing. But there's another way to think about this too. I mean, instead of just owning slivers of all these different companies, what if you could own an entire business that also pays you passive income without having to worry about any of the day-to-day operations? Well, that's exactly where the sponsor of today's video, Limits Express Company, comes in, and I want to tell you a little bit more about them. So Limits Express is a company that fully manages Amazon stores for their clients using Amazon's fulfillment service, known as Amazon FBA or Fulfillment by Amazon. Essentially how it works is sellers send their products to Amazon's warehouses and Amazon takes care of the rest. It's a completely hands-off way of running an e-commerce store, and Limits Express makes it even more hands-off by setting up and managing the whole thing for you. They run fully managed Amazon FBA stores selling everyday consumer staples like toothpaste, mouthwash, deodorant, razors, stuff like that. Products people buy no matter what. And the products they sell are made by some of the biggest brands in the world, household names like Procter & Gamble and Colgate-Palmolive, which are companies we talk about quite a bit here on the channel. Now, what I really appreciate about Limits Express is their transparency. In the same way that I document my dividend investing journey here on YouTube, they're documenting their entire business on their YouTube channel. They make educational videos about Amazon FBA and also put out regular updates showcasing their clients' results. And actually, guys, I'm in the process of setting up a store with Limits Express right now as we speak. And as soon as that's set up and rocking and rolling, I'll definitely show you my results so you can see them for yourself. So like I said, Limits Express does all the heavy lifting and handles all the details of managing your Amazon store. You just split the profits. They're fully transparent, performance-based, and they only make money when you do, so they are highly incentivized to drive returns for their clients. And when it comes to returns, they're legally required to report their returns to the FTC. And according to those disclosures, which you can find on their website, clients are seeing average returns on investment of about 14% every month, which is a huge number when you think about compounding over time. Now, if you're interested in learning more about generating passive income through Amazon FBA, just click the link in the description of the video or in the pinned comment, or just scan this QR code right here to book a free 30-minute Zoom call directly with Kyle, one of the company's co-founders. If you're thinking about getting into Amazon FBA, I truly believe the best way to do it is just by outsourcing it to the pros who live and breathe this stuff every day. So definitely set up a call and start generating some more passive income with Limits Express Company. All right, guys, now getting back to it and moving on to our third question of the day. This one comes from my friend Joel, who wants to know, have you ever considered buying a non-dividend stock? Like a stock that has everything you wanted in a company, but it doesn't pay a dividend. Yeah, I've definitely been interested in a few non-dividend paying companies over the years. I think Spotify is a really good example, actually. I've been a loyal user of theirs for a long time, and I always thought it'd be a good candidate for me to consider if I were ever interested in any non-dividend paying stocks. But when it comes time to actually pull the trigger on a non-dividend paying stock, I don't know, guys. I just can't do it. I mean, for better or for worse, that's just how I roll. With that said, there are undeniably plenty of phenomenal businesses out there that don't pay a dividend, but as someone who hopes to eventually live off dividend income, having a dividend is non-negotiable for me right now. And to me, it's no different than only wanting to invest in companies that are growing their revenue or growing their free cash flow in the same way that I want to see growth in those departments. I also want to see the presence of a dividend. It's just part of my criteria. Now, is that going to cause me to miss out on some great investments? I'm sure it will, but I'm also okay with that. I mean, there are still hundreds of high quality dividend paying companies out there, so I really don't feel like I'm missing out on much. I think I've done pretty well going this way. In fact, I actually find it helpful to narrow my focus a bit more. I think it gives me a clear sense of direction when it comes to finding new investment opportunities. And does that mean that I'll never invest in a non-dividend paying stock? I mean, not necessarily, never say never. For now though, I'm just laser focused on stacking that cash flow and building up my dividend snowball. But with that said, at the same time, if In-N-Out Burger ever goes public, even without a dividend, I might have to make an exception there. That is one company I feel like I'd have to own no matter what. And actually, now I'm curious, if you guys could invest in any private company out there, which one would it be? Let me know in the comments. And then with that, guys, this is going to bring us to question number 4, which comes from Jordan, who asks, do you ever get burned out on investing? All the research day to day. And the short answer for me is not usually, but I do understand how someone could get burnt out on all this stuff. When you spend a lot of time with your head in the stock market, constantly reading, keeping up with the news, analyzing stocks, it's easy to hit a point where it does all start to feel like a bit too much. And in the handful of years I've been doing this, I've definitely felt that way on more than one occasion. I mean, the flow of information in news, it never stops, which I think is both a blessing and a curse. With an unlimited amount of data at our fingertips, there's always more to read, always more to learn, always something to consume. And while we are so fortunate to live in a time where we have all that access to information, at a certain point, it does stop being helpful and it starts to become a bit overwhelming. And personally speaking, if I were to try and keep up with every little thing that was happening in the stock market every single day, I would definitely eventually hit a wall. And I think that's where I've gotten in trouble in the past, is doing exactly that, trying to keep up with just everything going on with every company out there. But over time, I do think you learn to get away from that. And that's one of the reasons that I love dividend investing so much, is that it allows you to kind of detach yourself from all of the noise out there. And it allows you to take a step back, and instead of worrying about the day-to-day, you can just focus on the long term. In other words, the beauty of dividend investing is that it doesn't require you to be glued to the market every day. You don't have to read every single headline, and you don't have to constantly trade in and out of positions. And when you own businesses that continue to generate cash flow and pay their dividends no matter what's happening in the market or in the economy, I think you can afford to step away for a bit and take a break if ever you feel like you need to. That's totally fine. At the end of the day, it's important to keep in mind that investing, it shouldn't be stressful. Your portfolio and the stocks that you own are there to support your life, not make it more difficult. And if for some reason it is making things more difficult, then maybe you need to reevaluate your positions, and maybe that's an indicator to simplify things. Personally speaking, if the stock market shut down for 5 years and I couldn't touch any of my positions, I would feel totally fine. I'd feel pretty confident that all of my stocks would just continue running and keep on keeping on. And that's exactly what I want out of my investments. And with that said, if you want to see my full dividend stock portfolio, then check out this next video right over here. In this one, I'm taking you completely under the hood and showing you every single holding in both my main taxable account as well as my Roth IRA. So click right over here to get the full reveal, and I'll see you in the next one.